Hey everybody, this is Jose Blasco here. We are about to start the session. Uh, we'll do a quick sound check to make sure everything is working fine. I believe everything is good. I can see you guys are already texting on the chat box, so I am guessing that all is good for the session to begin. Again, welcome to the session, everybody. So I'm just gonna go over the introduction slide, the disclaimer, and so on, and we will begin. So, disclaimer, the following videos clips demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. So that's the disclaimer for today, April 23. Today we're getting together to do some longer term trading. And with no further ado, I am now moving from the introduction slide into TradeStation, which is where we're gonna begin everything that we do. Marcus, how are you? Ruben, good to see you, my friend. We were in the backtesting class together just a few minutes ago, isn't it? Denny, how are you? Charles, Gali, very nice to see you all. And let's begin. So let's go for it. Today, as I was saying, we're getting together for longer term trading purposes. So in that sense, I would like to zoom in the TradeStation scanner, which I have run before the market opened. That was a little over 2 hours ago. So if you were to run the scanner right now, you may get slightly different results. Okay, so we'll look at that. But basically, we have on the top debit opportunities. So this is for us to be directional, either directional to the long side or directional to the short side. And then we got credit opportunities, which is for us to be purely non-directional, ND, or less directional, which we call it neutral long or neutral short. Okay, and these are the four types of opportunities. The five types of opportunities that we normally deal with in the sessions. We're gonna start today with pure non-directional opportunities. This is when we build our credit spreads. And from there we'll move into directionals, and if we don't find anything in non-directional and directional, so then we'll go for the neutral. Okay, so this is kind of the sequence we normally run, which makes sense. Okay, so I'm gonna click on non-directional. Today, when running the scans, we came up with two results. One is GLD and the second one is IEF. Okay, IEF is an ETF. Okay, so we'll skip that one. Give me a second here. I would like to make the cell to be a bit smaller. Yeah, not sure why it's not allowing me to adjust this right now. Okay, so I'll play with that later on. But basically, IEF is an ETF that is currently trading at $122. GILD is a stock trading at $81 per share. So we're going to start with GILD. ETFs normally are markets that we don't utilize when doing short-term trading. I'm just realizing I didn't turn on the video stream. How are you, my friends? I should have done that before. And so I was saying that ETF, normally we don't use them for intraday trading. Let me rephrase that. ETFs, normally we don't use them for non-directional trading purposes, because normally ETFs represent less risky products, and therefore the premium attached to less risky products is normally less. So we normally use individual stocks for that, and we manage the risk by doing iron condors, because we sell units, we buy units, so we know no matter what, our risk is predefined at all times. So when dealing with stocks, especially when ready to do a non-directional trade, we certainly need to be very well aware, okay, of the earning dates for that stock. In this sense, I'm gonna load GILD on TradingView, and we can see the earnings report is gonna happen on May 1st. So if I look at the calendar, okay, if I look at the calendar, next Friday is 24, and the Friday after is the first. Okay, it's the first, and that's gonna be the day when we got the earnings. Okay, in other words, we cannot use that date because we may get a jump on price, which is the opposite of non-directional trading. Correct? So we may get a big jump on price prior, okay, to the earning report. And that prior maybe just a few hours before, but still it's still a jump. Okay, so we want to avoid gaps against us when doing non-directional trading, and therefore if we're gonna make a trade work on GILD, we're gonna have to use tomorrow's expiration date, which is April 24. That's the only way to approach it in a way that is sensible. Okay, so with this in mind, okay, we're gonna have to load more UFOs. Okay, but at the same time, I don't want to waste too much time because I'm not sure this trade is gonna work. Okay, so what I'm gonna do is I'm gonna load Option Station Pro, and I'm gonna do something that we normally do. Okay, so Option Pro coming. Basically, I'm just going to look at the call side and calculate the expectation for price movement from current price to tomorrow expiration date, and look at how much the calls pay us at that price level. Okay, because we have requirements, isn't it, when it comes to minimum levels of premium to be accepted. Okay, so if I bring sharpening nodes into the screen, so I'm bringing this in a second. Okay, so if I bring sharpening nodes into the screen, okay, so you probably remember we have it right here that we need a minimum of 15 cents. Sorry, I'm not sure what's happening to me with the figures today. I was thinking of 15%, but that's not what we're looking for. 35 cents is what we're looking for. And there are cases where we are okay with 25 cents. The question is how much we got with GILD. Okay, so we're going to load GILD. Okay, we're going to look at the option chain, which is loading. Okay, and normally what we do, okay, I'm just going to show you a quick way to do this. Okay, normally what we do is that I would insert an iron condor here, and we have the plus and the minus standard deviation, isn't it? So normally the moment I get April 24 and I right click and I analyze and sell an iron condor, okay, using that date, okay, which is April 24, immediately it tells me that 87, it's the further price should go based on probabilities, okay? And therefore, my intention here is to look at how much the 87.5 pay, okay? And notice here is 24. The midpoint is actually 36. So we may have a trade, okay, given the amazing level of premiums, 84%. Again, those are distorted Greeks. If you look at the next month, actually, we even got more. Well, that's because of the earnings, 95%, but still 85, 78. So huge amounts of levels of premium. We know, if I look at the, back to TradeStation, if I look at the VIX, okay, if I look at the VIX, we know volatilities are very high. Okay, we've been trading around the 40s, isn't it? With the VIXs, not 39.5 at the moment. So I mean, we went all the way to the 80s, isn't it? But still 40, it's 3-4 times more than normal market conditions back in January, February, where we were around 15, isn't it? So the levels of premiums available are huge. GILD being $81 per share is not like it's a humongous price for a stock. Okay, it's just a normal price, if you wish. You would not expect that much premium built in the options. Okay, an option located at 87.5 or above, you would not expect that much premium left. But again, given the fact that we've had such an incredible increase in premiums, given the craziness that is happening in the world and definitely reflected in the marketplace. So we do find that very, very nice, quantity of premiums, in those options. Okay, so we are very happy about that. But in order to be able to plan the trade, I need to look a bit beyond what we've got. And I can see here I got purple lines, probably from a prior session that we did before. So I'm just going to delete those purple lines so we start from scratch. But basically, I'm going to have to load market data all the way to around this price level, which is December 15. Okay, December 15. So what I'm going to do, because this is going to consume a lot of computer power, it's a lot of data to be loaded on the screen. on the 55-minute time frame. Okay, so I'm moving now to 55, as you can see right there. Okay, you can see here 55 minutes. Okay, but now what I'm going to do is I'm going to change the first date. Okay, I'm going to change the first date to be December 2015. Okay, and therefore be able to recalculate all those UFOs. Okay, so we have the PD pending data here on the upper left. We're just going to wait for this to go away. That's it. It just went away. So now that it went away, I'm going to use the command period OFF. Okay, so .off for me to be able to select working offline. This basically disconnected thread station. You can see it here as well. Everything became red color, isn't it? So I'm disconnected. So now even though I got huge amount of data, I can run the UFOs without overloading my computer. Okay, and in this sense, we're gonna be able to uncover where the UFOs are. So I got UFOs at 87 point something. Okay, and I got UFOs as well here. This is with regular data, okay, regular session hours, which provides 56.19% probabilities, UFO performance stats, I should say. And when I switch to pre-post market, we may get new possibilities, okay, and certainly we can see how we do have a UFO here that goes a bit beyond that, which is right there, okay, at 89.5, and then we have a collection of UFOs below as well, which I'm just gonna go ahead and draw. Okay, so later on we can just play with all those purple lines. So I'm just going to where each UFO is. In this case, in the using pre and post market data, we will do that right now. Switching to regular session, we may also find more green UFOs, or maybe not. So we will see that those coincide and those three coincide. Okay, so I think that's good enough. Okay, given the size of the range that we have here, that would be good enough. And what I'm going to do now is I'm going to reconnect. So I can double click on the red light. That would allow me to reconnect. Or if you prefer to use command, you just go for .on for online, and here the bottom option is working online. So select that one, and then of course we're going to have to re-enter the password, and the moment we do that, we are back in the game. Well, actually, I should have reduced the amount of candles to minimize the processing power impact. Let's hope it's not going to be too bad. So I can edit. Here we go. I'm going to go back to my normal amount of candles, which will make the red UFOs to go away, but I got the purple lines that represent where those UFOs were before. Okay, so this is what we've got. This is what we have when it comes to key price points on the chart, thanks to the UFOs represented by all those purple lines. And now we're gonna go back to not TradingView, back to Option Station Pro, and now get a little bit more precise with the definition of our iron condor. We know that 87 or above is good, 79 or below is good. So of course, the further away the better, but at the same time, notice how the 87 call using April expiration, or 87 or 87 something, it's paying 42.37, so that's good. But if I go much further, 88, 88.5, 89, now I may get in trouble because I only get 20 something. Okay, so I need to be careful with that. 79, which is the bottom part, only pays 32, so I cannot go that much lower than 79 either. So the question is, where should I draw the line in the sand and be happy with the distance? Okay, so if I was to start, by the way, and also remember, we have a rule, which is we need to use at least 2 UFOs, right? So if I go from here to here, okay, we go from here to here, that's the vertical distance to the second UFO. So if I was to project this below, okay, this basically brings me down to 75.92. And that's actually not a very good news, because if I go down to 75.92, which is 76, so that means that as the upper part of the range, I need to use the top one. Okay, so the range will be now defined by 89.5 and 75.92. So this is a very, very high probability range. That is fantastic. But with only 1 day to go, even though options are very, very inflated, so 89.5, how much I get paid for the 89.5, I believe is not enough. So 89.5 pays me 23. So that's not enough. I need 25 minimum. I don't get that. And then the bottom part, which is 76. So the 76 is paying me only 9 cents, which is certainly far away from the minimum 25, ideally 35 or above that I need. So yeah, so the iron condor is not valid, okay, because of that. If earnings were, instead of happening on May 1st, they were happening on May 4 or something like that, then we could use the next week expiration and that would change everything, and probably this would be a great trade. And by the way, this trade, probably if you plan this trade 1 or 2 days ago, probably it worked very well, but not today any longer, since tomorrow it's too close from today. Okay, so we are not gonna execute this trade. What I'm gonna do is I'm gonna rerun the scan to see if the scan finds any new opportunity for non-directional purposes. So we let that happen in the background. I'll check your comments here. So Mark, how are you, Mark? Ahmad, I was is the theory that says the body of the base less than equal to 50% of the range is the correct way to look at on-field orders area? I'm not sure. Are you referring to the calibration of the app? Because that has nothing to do with anything I have ever taught in the YouTube channel. So if you are referring to the calibration, please let me know. Good. Okay. So as I was saying, we're gonna leave the non-directional scanner to run here in the background. Okay. And I'm gonna move now to directional opportunities. Okay, directional opportunities. Before I do that, by the way, very quick, I want you to understand where the S&P is at. Okay, so I'm gonna remove average true range. So loading the S&P ETF, SPY. The moment the SPY ETF loads, I want to make a comment that I make all the time, but it's critical that you guys remember. So take a look at what's happening here on the S&P. Okay, so candle number one. Okay, new climate defined. Okay, candle number one of what could be 11 candles. Okay, so certainly a portfolio that is managed properly should always utilize, should always use positions where some of them are long, some of them are short. So if something crazy was to happen, you always have some sort of a hedge protecting you. The positions that lose whatever amount is defined by the option strategy that you have used, while the positions that profit, they profit more, while they benefit from a gamma hedge, isn't it? And your portfolio overall will provide some sort of a performance. Now, your portfolios are the ones that dictate how many positions you need to be long or short based on the climate parameters. Okay, so we just went through a little bit of a hiccup, okay, which could be seen as a little bit of a problem. Well, actually, that little bit of a problem is actually very, very healthy, because basically it broke and reset the statistics of climate analysis. Okay, so we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Statistics suggest climate should be around 10. That happens. We got a pause. The market is breathing, and now seems to be to restart another climate that, based on stats, would be another 10, 11 candles. Again, these are just stats. It doesn't mean it's going to be like that. It could be anything else, because anything could happen anytime. But it's good to know. It's good to see that we are restarting that. And therefore, in your portfolios, if you are following what I just explained about how your portfolio should be constructed when it comes to long and short positions, you should be ready or happy, or both, ready and happy, to prepare to get yourself into new long positions, because this is what the market basically is telling you to do. But of course, not only long, you should have already short positions in the market as well, And if you don't, you should also be looking for short positions to hedge. So my assumption, as I said millions of times, is that every trade I identify, I will assume you need it, and then I'll go beginning to the end to plan the trade. Of course, you taking the trade or not depends on what you already got in your portfolio. Let's say you already got 20 positions to go long with a lot of risk each. Well, you should not take another long. Actually, you're probably overexposed. Okay, so keep all of this in mind. Uh, Yeah, no worries. I mean, all questions are valid, Ahmad, and there are millions of ways on how to trade and millions of ways on how to make money in the market. So certainly, I welcome all questions. Okay. Now today is a trading day, so I just need to keep going. Okay, but we can talk about those things in the sharpening sessions as well. Okay. So anyway, I got my list of directional opportunities to the upside. I'm sorting the list, okay, from top to bottom. The most expensive stock in the list is Adobe. Then we go to Costco, etc. So just to find, let's say, a fair price point, okay, I'm gonna go down the list, starting from the most expensive stocks, okay, but I'll stop first in the stocks that are very, very liquid. For example, Home Depot, UNH is fine, Costco is fine, Adobe is fine, but let's begin with Home Depot, which normally it's quite nice for you to get feels and so on. So I'll start, since we got many today. Okay, not every day is like that, but today we have many. So I'm gonna be picky and go through the list, knowing the stocks I know when it comes to liquidity based on my prior experience trading, and the ones that are better than others. That's where I'm gonna stop first. And if I don't find anything, like it's the case with Home Depot, notice we got 12 candles in the climate, where the climate in Home Depot is supposed to be 7. Okay, so this market is certainly probably tired of keep moving higher, because it's been moving higher longer than what probability suggests. So probably is not gonna continue, or if it's gonna continue, probably not that much further away, because it's been already moving non-stop in that direction. Okay, anything could happen again, but that's what probability will suggest. So I'm gonna move to the next one, which is Goldman Sachs, which is another pretty liquid instrument to be traded. Okay, and if you don't mind, I'll take a sip. Okay, so Goldman Sachs is looking better, to be honest, from a climate point of view, because it's doing exactly what the market is doing. So we have candle number 1 out of 9, and very close to the EMA 176. So we may be able to find a setup that works here. We just need to wait for the pending data to download, and then we'll be ready to begin planning on this trade. Okay, so Goldman Sachs could be a candidate. Okay, so let's see what we've got in Goldman Sachs. Now, of course, when pending data goes away, the first thing that we need to make sure is that 45, that's not acceptable. We need at least 50% for us to take the trade. So when that happens, one way to check if we still have a second chance is to move to pre and post market data, because again, in this case, it's about the same. It's 45. So institutional interest is limited on that stock. Okay, so we'll forget about it. So I'm gonna work to regular, and we'll forget about Goldman Sachs, believe it or not. Okay, there are plenty of unfilled orders being canceled compared to other stocks where we've seen like 56%, things like that. So many orders are canceled on Goldman Sachs unless they get filled, and of course that reduces our probability, even though it's not critical with stocks. And that's why we accept 50%, because 50% it's actually not amazing, right? It's 50%, but we accept 50% because really stocks are by definition a fragile asset. That depend on so many other things. So dealing with stocks, like if it was to be futures or forex and be too demanding, would basically have you never trade. And therefore we need to be flexible, but at the same time 45% is way below 50, so we draw the line at 50. Okay, so 17 out of 7, that's what Johnson & Johnson provides. That's not good. Okay, so I'm gonna keep going down all the way to Procter & Gamble. Okay, and see what this company provides us with. So let's take a look. From a climate point of view, we're going to discard it right now, right? Because it's 19 out of 7. Okay, so not good. That's probably a very tired market movement. Okay, and I'm going to look at DocuSign, This is the last stock I'm going to look before I keep going down. If that one is not good, I'm going to go back to the top to the list. Okay, so that way I'm not below the 100% the $100 mark, and then I would when I complete that, then I would continue with stocks which are cheaper. Normally, when trading options, okay, at least that's my preference. It certainly depends on each trader, and certainly depends on the amount of capital that you utilize in your trading account. But in general, I don't like to use stocks that are too low priced, because options are going to provide me an advantage which is greater based on leverage the higher the price of the stock is. So if the stock is very cheap, let's say $10 per share, then using options it's certainly could is doable, but it makes much less sense compared to a stock which is $100 per share. Okay. So in that sense, that's why I'm going to do what I said. So with DocuSign, notice we have a no as well. So 12 out of 8, that's a no. Okay, we're not going to go for that. It's already surpassed, that 8 number. So we're going to go back to the top of the list now, and I'm going to restart with Adobe. Then we'll go to Costco, then UNH. So Adobe is looking good. Okay, Adobe is looking good. We got 1 out of 8. Okay, so in that sense, we are at a good time climate-wise. Okay, that's good. 334 is our reference price. So now we will want to look for UFOs that are located at 334. And guess what? We have one here. Now, of course, we still got pending data, and hopefully pending data will change 23 to become 50 or above, because if not, we are not in a good position, and we do. Okay, there is institutional interest on Adobe, as you can see here, with a higher UFO performance stat. Okay, so that's looking good. Okay, that's looking good. Now, before I conclude this is the trade we take, I want to check pre and post market too. So instead of 52, what do we get? We get 50. So 50 is a bit worse. Okay, 50 is a bit worse. Still, I want to draw. I don't really care about the whole UFO, but really the meat of that UFO, the inner circle. Okay, the inner circle. That it's an interesting price point where it's going to be overlapping the other UFOs from the regular session. Okay, but basically what this is telling me, okay, because here's what I was thinking behind the scenes, and that's why I did what I just did. So here I got 2 UFOs, right? So I got 2 UFOs, and basically there are a lot of unfilled orders here. Okay, so that's very good to see. But also from the pre and post market data, okay, it's kind of like we have another circle in here. Okay, this is the inner circle of the UFO that we found on the pre and post market data. So entering here would be valid, but you may miss the trade because of that. Okay, and that's what I wanted to see. Okay, so basically what I'm going to do is I'm going to look at the next UFO, only the inner circle that happens to be lining up with the top value of the UFO band right here. Okay, so therefore I'm going to use that 336 as my entry point, which I know 336 is above 334, but again, all that area is packed with unfilled orders, and I just said it, and I'm going to say it again: stocks are fragile. So we always need to be flexible when it comes to the use of the entries and the exits, because they are not as robust as other markets which are independent, such as let's say gold futures, for example, or an index or a treasury. So those or a currency in forex, right? So those markets are independent, stocks are not. Okay, so anyway, it seems that we do have a valid entry here at 336 with everything I just said. You guys hopefully are with me. If you're not with me, make sure you explain it or you phrase it on the chat box, and that way I will be able to take a look and answer. You call the inner circle the nucleus. Very good. I love it. I love it, Mark. That's I love that definition. Marcus, Jose, why don't we add climate to the scanner so we would not need to load all the data and check manually? Well, because I'm trying to find a little bit of a balance, Marcus. Not everybody here uses TradeStation or has availability to have a TradeStation account. So somehow the scanner is a bit more generic, using EMA, ADX. So this could be programmed potentially in other trading platforms. To be honest, not many trading platforms have the capability of TradeStation, but at least I want to find a little bit of a halfway, if you wish, to provide ideas and methods and processes to everybody, no matter the platform you use. Even though in the end, for sure, the more similar the technologies that we use, the better, right? So that's why. Okay, good. Okay. Anyway, so going back to Adobe, so I am gonna turn on AutoUFOs now on the daily time frame, looking for my target. Okay. Now notice that we are hitting a UFO as we speak. Okay. So the rule is when price is already inside of a UFO or touching a UFO, then we go for the next UFO for the target. Okay. So this particular line, this particular price point, okay, that's gonna be my target for this trade. Okay. So we would expect Adobe to fall a little bit, and as Adobe rallies a little bit, when it gets there, we're gonna take our profit. So it doesn't look like we have a lot of room for profit, but it also depends on where the entry is and so on. So we're just gonna follow the process and go with it, because what the market is giving us is what we are given. We cannot change that, isn't it? We cannot move the UFOs. I mean, you could make up these. You can move the UFO wherever you want, but it would obviously be not a reasonable action. Okay, it would make absolute no sense to do anything like that. Okay, so wait a minute, I forgot to make a note of the price point for the target. So the target would be located at, let me make a note for myself. So the target will be located at 347.19. So that is for Adobe. Okay, 347.19. So I'm going to turn off AutoUFOs and go back to my entry point here of 336. And now I'm going to start loading Adobe on the option chain, because I have a little bit of work to do here to adjust this trade and see how we are going to execute it. So loading Adobe. Okay, different expiration dates. Okay, so let's talk about everything. Okay, so first let's go ahead and work on earnings as well as time to target. So Adobe ADBE, let's take a look at the earning date. Earning dates for Adobe shows right there, which is 11th of June. Okay, so we have some time, almost 2 months. Going back to time to target, I'm going to calculate with a calculator, simple math, the distance from the target we said would be, which is 347.19, and the entry, which we said is going to be 336.03. Okay, so the distance is $11.16. So this is the amount of price, the amount of space price we need to travel for us to end up in a profit. Okay, so if we take this number and we divide it by the daily ATR, which is 13.63, okay, it would take, based on that approach, 0.81 ATRs to get to the target. We are giving ourselves 7 days per ATR to get to a target. So that would mean that we should get there in a week or less. Okay, of course, and it's quite visual. You can see 347 is right under 350 right there. So it's not like we are that far. So we are basically looking at a 1 week trade, something like that. Okay, so hey, that's okay. That's okay. Let's take a look. So let's input the parameters of the trade. Okay, so 347.19, that's the target. 336.03, that's the entry. Okay, so if we were to look at this trade, knowing that we need 5 days to get to that price point, we would use May 1st expiration, which provide 8 days. Okay, but the other rule that we have when it comes to calculating targets, to picking expiration dates, is that if the earning date is happening after that date, which is the case, 11th of June, so then we like to pick the expiration date that is the closest to that date. In this case, it's going to be 19th of June, which is 57 days. Okay, so this is the one we're going to pick. And what I'm going to do here is I'm going to right click to analyze and buy. And from here, I'm going to pick two different strategies. I want to analyze a vertical spread, which I believe is probably what's going to work better, especially when the stocks are of a higher price point. Normally, it works better. Now, having said that, you can see the strike price increments on the option chain are $5 at a time. So 325, 330, 335. So when you see that, it's a little bit of a potential for problems in the sense that we may not be able to adjust the Greeks impeccably the way we need. Okay, we'll see. If you had strike price increments that are one at a time, normally you are more precise at adjusting the Greeks. But again, sometimes it works well. Many times actually it works well. So we're gonna plan for a vertical and adjust it. But I also want to do a single one. Okay, so I'll do both: a vertical, back to options, right click, analyze and buy, single. Okay, so am I inserting a vertical and now a single? So that way, now here I got both. Okay, I got both. I got the vertical, okay, and then I got the single, and I'm gonna be working on those on parallel. Of course, I need to be very careful about the check marks here on the left, because if they are both checked, it means both are acting on this simulation. So I'm gonna uncheck the single. I will start working on the vertical, which as you can see is checked. Adjust the vertical, see if it works, and from there compare with the single to see what is best for me. Okay. Now the rules, probably you remember, for the ones of you attending the session for the first time, or you may not join us for the option sessions too often. So I wanna write the rules here so it's visual. So the rules that we have is to sell a call beyond the target, okay? And because the target is 347, so I am going to propose sell the 350 call, at least in my initial approximation, which probably will need to be changed, okay? And then we need to buy a call, okay? We need to buy a call between, okay, it's not beyond, it's between entry and target. Okay, so if the entry is 336, so maybe I'm gonna say, what about we buy the 340 call? Okay, the 340 is between entry and target, and the 350 is beyond the target. Okay, so this may work. To be honest, I don't think so. I think we're gonna have to do adjustments, but that's gonna be my starting point. I'm gonna take the 350. Okay, I got the 350. I am selling it. That's what I said. And then when it comes to buying, here I'm buying the 345. This is not what I said. What I said is that I would buy the 340. So when I change this, what happens? Well, when I change this, I end up with 7 delta. And that's not good because our rule requires a minimum delta of 30. Okay, so what's the way to fix that? Well, we're gonna have to push beyond 350, the 350 option. So we're gonna move it up, let's say 360, and see what happens. So now my delta is 1398. Okay, so it seems that it's not enough. We're gonna have to push it. What about 380? Now I got 26. What about one more? 385. Now I got 2943, and I would say that is quite nice. Okay, this is very nice, and it brings the options price where I need it to be. Okay, so the delta where I need it to be, not the options price. So the delta is 30. Okay, and then the gamma, not only the gamma is positive, which is what I need, but also notice how the gamma at the target point, okay, which is 347.19, it's also positive. Okay, and that in this case is quite easy to accomplish because, to be honest, the target being so close, both the gamma and the delta are going to be about the same. It's not going to be a big difference. 29.3 and 30.2, it's about the same, and as it's because the distance between entry and target it's not too much. Okay, so that's what we got. Okay, and that's what we have adjusted as a vertical spread, and that would be a valid way to execute this trade. Okay, now if instead of a vertical spread I wanted to do a single option, so notice I just unchecked the vertical and I just checked the single. So if I was to do that, and I use the 340. So my problem is that delta is 50, is too much. Okay, so I'm gonna have to rise it to, let's say, 350. And if I do that, I get 43. If I keep rising it to 365, for example, I get 33. So if I move it 3, let's say 370, I got my 30 delta. Okay, I got my 30 delta with my positive gamma. So you would say, that's it, I got it, it's all good. Okay, but I would not recommend you to do this trade. Okay, I would not recommend to do this trade, guys, because this option not only is out of the money now, this option will remain out of the money all the time during the life of the trade. And that's a problem, which you can see clearly identified here with the theta, where no matter where you are, you are losing $16 to $18 per day just to be in the trade, which is eroding a lot of the value built in this option. Okay, with the vertical, if you compare, instead of 18 and 16, okay, you got 7 and 4. And notice how, as you move towards the target, you are losing less. And why is it that you're losing less on time decay as you move closer to the target? Well, because while the 385 option is out of the money, okay, the 340, which is out of the money at the beginning because you buy the 340 when the stock is trading at 336, so that's out of the money technically, isn't it? But as the price of the underlying goes up and reaches 347, so when you reach 347, the 340 option is now in the money by $7. In other words, not only you have time value, you also have intrinsic value, and therefore there is the net effect, if you wish, when it comes to how much value the option loses. Is it's if you wish, that loss based on time decay, it's less problematic because the option not only is made of time value, there is also intrinsic value built in the option. Okay, so in this particular case, certainly the vertical spread will make more sense. And this is not the trade of the year given how close the target is, but this is a value trade that may work very well, very easily. And this is an opportunity to make around 300 over dollars, if I'm not mistaken. And why not? Okay, yeah, as long as that you need a long trade in your portfolio. Okay. Let me see. June 11th. Thanks for that, Mark. So, yeah, so that's what we have. Okay, so let's place the order. Okay, for that vertical spread. Okay, so we're gonna go ahead and trade. Okay, so we're gonna go ahead and trade. For sure, this spread it's a bit wide. Okay, from 90 to 45. Okay, it's 45 cents of spread. The reality is that this is a pretty expensive stock. It's $340. So it's not a crazy thing. It is not too pretty either, but it's not a crazy thing. Okay. So again, you can certainly use more advanced order placement like I did last week, for example, where I was using shaving orders. Okay, but you cannot do this from this order bar. So out of simplicity in this execution, I'll use market. So I shave not the price, but I shave a little bit of time. So then I can go back to the charts and look for another trade for you guys. Okay, so activation rule will be based on ADBE, Adobe. And we want this order to be active only if ADBE reaches 336.03. Okay, so that's going to be the condition, less than or equal to 336.03. Go for it, activate the order, and therefore buy the spread. I got market price here. Again, I recommend you to shave that to have a better entry price. Okay. No, I don't want to send. I forgot one thing. I want to make it day order. Okay. The order is important. So if you don't get filled today, the order is canceled. You don't get charged exchange fees for options. And tomorrow you can come back and revalidate the setup. And if it works, then you just go for it again. You just insert the order one more time. You just place the order one more time. Okay, good. So in the manage tab now, you can see we got a receive order, which is Adobe waiting to get filled based on the condition. So just using patience now for this trade. Okay, so trade number one for the day has been Adobe. No questions, everybody silent. Okay, I guess that's good. If you have any question, comment, go for it, my friends. So checking the non-directional trades one more time, just in case there is something new. No, we still got GILD and IEF. So yeah, no new non-directional trades after I run the scanner, okay? So since I plan on a long, let's go ahead and look for a short as well for the ones of you that need shorts in your accounts. So I'm gonna sort these based on price. And the first one we're gonna check is Tiffany's. So loading the chart. Let's see what Tiffany's is providing us with. That nice setup, very nice setup, in the sense that we have one candle out of five. It's the beginning part of the climate. So this is the perfect time to enter a trade, assuming all the other rules are met, which, we need to wait for the pending data to load, see where our UFOs are. What a monster UFO here. Amazing UFO. And you can see the reaction to it right there. Incredible. That's not something that we see often, isn't it? What a monster UFO. Anyway, so 55%, that's very nice to see. When switching to pre-post market, we got 40%, so not relevant for Tiffany's. The institutional interest is during market hours. And we have a reference price being 128.44. So we are looking for UFOs at 128.44. And I believe we may be okay with that one here, because the bottom part of that UFO is what? It's 128.90 something, 93, okay? And of course, for price to enter the UFO, it needs to go up. And if price goes up, that EMA, which is currently 128.44, may become 128.70. Okay, and that I'm gonna say is close enough to 128.93, because remember, it's okay to be flexible with stocks, because stocks are fragile. They depend on other factors, and trying to be too precise with stocks, it's a utopia. It doesn't make sense. Okay, so we have another opportunity here to be planned with Tiffany's. So loading the daily time frame, I'm gonna activate AutoUFOs to look for a target. So looking for targets on Tiffany's. Well, similar situation, unfortunately, though. The target is quite far. The target is quite close. Okay, so I'm just going to make a note for myself here. The target should be located at 125.86. So 125.86, that is the location for the target on Tiffany's based on AutoUFOs applied to the daily time frame. Okay. Yeah. So both setups are very similar, Tiffany's and Adobe, in the sense that they have little room for price to move. Okay. Well, 125.86 is actually somewhere here. Okay. Is actually somewhere here, which is very, very close. Okay. But again, it's a proper opportunity that meets our rules. So we're gonna begin planning for it. Okay. And this implies checking the earnings reports for Tiffany's, which are on May 5, as you can see. Okay, May 5. We are going to be looking at the option chain on Tiffany's as well. And while the option chain loads, I'll go back to the chart. Just said 125.86. Okay, so we're talking about a little over $3. The daily ATR, as you can see on the bottom left, is one all the way here to June 5, which is 43 days from now. And it's no way we're going to use this option chain with this terrible liquidity from 3 to 520. This is absolutely awful. Open interest, zero everywhere. Guys, when you see something like that, okay, make sure you look at open interest and the spreads. You cannot trade something like that. So let's move into the next one, June 19. Here we got open interest, okay? And here we got reasonable spreads, 275 to 3, that's fine. Wow, no one is buying. Look at how crazy this is. No one is buying the 135. No one believes Tiffany's is reaching that from now until June, like 3 to 4 cents. Where if you compare the 130 to the 125 in the put side, one is $5 something, the other one is $3 something. So the next one still got value. but the 135 got 0 point something. So it's really, really incredible low price. What a clear bias on the movement of the stock that we can see from the options prices. Okay. In any case, let's continue with our plan. Okay, and that would be June 19 will be the expiration to be used, because of course we only need 2 weeks to get to the target. Okay, May 8 would do, but also we want to mitigate the effect of time decay. Okay, so I'm gonna do the same thing. I'm gonna use, of course, the put side this time. Okay, not the call side. Okay, not the call side, because I'm planning on a trade to exploit a market movement to the downside. And I'm gonna do the same thing. I'm gonna right click to analyze and sell a vertical, but also I'm gonna go back and click and right click and analyze and sell also a single put. So then I can look at what's best for me. The price points we said is 128.93 was the entry, I believe. Let's not be overconfident. So 128.93, did I say that correctly? 128.93, yes I did. And the target is 125. Vertical spread check mark on the single. Let's uncheck the single so I can begin planning on the vertical. And the vertical really is gonna be the mirror image of what we've done before. Earlier, we were selling an option beyond the target to the upside. In this case, it's gonna be to the downside, right? So we're gonna go ahead and somewhere here we're gonna have to buy a put. Okay, so I'm gonna have to be more specific about that in a minute. And beyond the target, okay, we're gonna have to sell a put, okay, which that's gonna be beyond the target. Okay, so sell puts beyond target, okay, and buy puts between entry and target. Okay, so my entry is gonna be 128 something, so I may use the 129. My target is gonna be 125.86, so I may sell the 125. So if I do 129, 125, what do I get? Okay, using June 19 expiration, what do I get? So let's take a look. So selling the 135, okay, so that's not good. We want to sell the 125, okay, and then buying, we said, well, we don't have the 129, isn't it? So it's only $5 strike price increments. So if I do 130, I am above, okay? If I do below 130, it's gonna be 125. So I cannot buy the 125 and sell the 125. That makes no sense, okay? So because I only have $5 strike price increments and my target is less than $5 away, I don't have much choice here than using the 130, and I know that kind of breaks the rules between, okay? But again, if I use the 125 and my target is above that, then both of my options would be out of the money. When I reach my target, it's okay for me to start a trade. It's okay for me to start a trade with out of the money options when you start the trade. But if price travels according to plan, that options contract, the one I buy, needs to become in the money at some point. Because if I reach my target and everything is out of the money, then the effect of time decay is really problematic. Okay, so I'm gonna have to start with the 130 put. That's gonna make the trade more expensive, but it will allow me. That's the only way for me to work on adjusting this trade, because the strike price increments are $5 at a time. So I have no other choice than doing this. Okay, so if I do 130, 125, that gives me a delta of minus 20. I need minus 30. Okay, so I'm gonna have to push the 125 to 120, and that's giving me 30 something. And unfortunately, I cannot make it better. I cannot make it better, and the reason why I cannot make it better, it's because I only have $5 strike price increments. So maybe what I really need is the 123, but the 123 does not exist. It's either 125 or 120. So then I need to go for 120, giving me a little bit extra delta. Okay. Good news, I got the delta I want, a bit extra, and also good news, I got positive gamma all the time, which is nice to see. Okay, so that's one way to adjust the trade. The other way to adjust the trade would be using a single option and using the 130 put, okay? Because I cannot use the 125 put. I said it before, it would be out of the money all the time. So if I use the 130, what's the problem? The problem is that I'm loaded on delta. I got 65, which is double of what I need. Okay, so I cannot consider that option at all. And since I cannot consider this option because of what I just said, and the vertical spread actually meets my rules, so this is a valid trade to be taken in that scenario. Okay, so what do we do? I'm just gonna go ahead and place an order. Okay, so I'm gonna go ahead and trade. Oh, wait a minute. Let me stop there. I see something crazy here. BD0, and that is telling me that probably the 120 has no liquidity at all. So let's take a look at the 120, and if that's the case, we are going to have to cancel the trade. Okay, yes, very, very disappointing. 1 to 4.5, very disappointing liquidity right there. So that's not acceptable, and it's a shame, guys, but we're gonna have to pass on Tiffany's because liquidity would really hurt. Okay, would really hurt. So we're gonna pass on that one. Okay, how is it going so far, everybody? Sorry for that, guys. Mark, your translation says 127.77. Would you mind to be a bit more specific? What is that? Is it the price in the UFO? Is it the price of the simulation? Would you mind to tell me exactly what it is? Okay. And also, Mark, beyond this, I owe you a response to an email. Okay. And also, I wanted to share something with you. So if you have a minute, send me an email after the session and I will reply to your email and let you know about something that could be interesting for you. So 127.77, what is that? Is it the UFO? Is it the simulation? Okay, everybody's very, very quiet. So I'm guessing it's all good on your end. The price of Tiffany now is 127.70. Oh, okay. Yeah. So in the simulation, Mark, I am not even simulating the current price of Tiffany's. Notice I'm simply simulating the price at entry and the price at target. I am not simulating the current price. Okay. So at entry, this spread, if we could execute the spread the way it should based on liquidity, but it's not the case. So then the spread would cost you 181, let's call it 182. So your risk would be 182 at entry. That's it. Okay. So really, it doesn't add, if I was to add a price slice and make it the last, which is the 127.70. So those parameters here really are not really helping me. They're telling me the price of the option is 220, well, I know that already. The delta is 30. Well, that's not useful because I'm not taking the trade now. I will take the trade only when Tiffany's reaches 128.93. Okay, so that certainly you can have it there, out of curiosity, but sometimes in life less is more. So really that row in my mind is not needed. So I would just remove it and that's it. Yeah, the dollar risk on the Adobe trade would be in the Adobe trade. Got it. So back to Adobe, Marcus. Sorry, I almost misunderstood. So looking at Adobe, it was $1,500, I think. Let's take a look. So Adobe entry long, here we go, 1,550. Let's call it 1,550 will be the expected value of the option at entry if Adobe drops from the current price to 336.08. Got it. Wonderful, everybody. So all very good. I think that we just reached the ending time for the session, so we are done for today. Pleasure joining us for this 1 hour. And also, quick reminder: this Sunday, this coming Sunday, we have a sharpening session. Okay, you guys probably are aware of this. Just in case, we have a sharpening session on Sunday. Make sure you're ready for it. If you have questions, send emails ahead of time so we can, I can read it. I can be prepared for your questions. You don't have to. If you show up on the session and you just phrase your question in the chat box, I'll be more than happy to also assist you in that sense. But if you send emails ahead of time, normally it's much better because you can document your questions better with screenshots and things like that, and then the session can be richer for you. Okay. So also, if you have questions and you cannot attend the sharpening session on Sunday, it's okay for you to send your question in an email. I will give you the answers in the sharpening session, and then at your own page you can go ahead and watch the recording and you also get your answers. Okay, so keep all of this in mind, counting on you. Okay, normally during the trading days I tend to answer very few questions, or if I do, normally the questions I would answer are more questions that are related to the execution or some important doubt that is happening right now with the trade right now, or maybe something very special that is happening in the market right now that, if we comment on Sunday, it's too late because it's happening now. So then questions, addressing questions of matters of this sort, I'm more than happy to do that in trading days, even though it kind of kills a little bit of trading time, but it's okay, it's worth it. But, everything else, which is methodology wise, theory wise, concepts wise, terminology wise, use of whatever wise. So you get my point. The right place and time is the sharpening sessions. Okay, so see you then. Counting on you again, and hopefully the session was helpful to you guys. And see you soon. You guys take care, and for sure, stay safe, stay healthy, be safe out there. Lots of crazy things happening. Everybody, please take seriously what's happening in the world with the viruses and everything else. Just like trading, never be overconfident, because certainly certain countries are in a very bad shape. So that could happen to anyone, anytime, anywhere. So everybody, let's help each other and be respectful. Take care, everybody. Bye bye.